Maximizing your tax benefits often depends on your participation level, and short-term rentals have a unique advantage. Let's unpack the rules and opportunities. Let's start with the basics. Passive participation. Most rental activities are passive by default. This means losses such as depreciation can only offset passive income, unless you qualify for certain exemptions. Active participation. If you're actively involved in managing a rental property, meaning approving tenants, handling repairs and maintenance, arranging the insurance, you may deduct up to $25,000 of losses against non-passive income, provided that your modified adjusted gross income is under $150,000. The short-term rental loophole we've all been hearing about. Short-term rentals are a game changer. If the average stay at your property is 7 days or less, the IRS does not classify it as rental activity for tax purposes. Instead, it's treated as active income, even if you don't qualify as a real estate professional. To take full advantage, you need to meet material participation requirements. The good news is, the bar is much lower for short-term rentals. Here's how you can qualify. First, the 100-hour rule. If you spend at least 100 hours managing the property and perform substantially all of the work, meaning no one else, such as the property manager, contributes more time than you do, you meet the material participation threshold. Number two, multiple properties. If you manage several short-term rentals, you can aggregate the hours across those properties to meet participation requirements. This loophole allows you to offset active income like wages or business earnings with depreciation and other deductions from your short-term rental. For long-term rental properties outside of the short-term rental loophole, achieving real estate professional status requires this. First, 750 hours per year in real estate-related activities. Second, spending more than 50% of your working hours on real estate. For properties that include an active business, like car washes, gas stations, or self-storage, the classification depends on whether the income is derived primarily from rentals or the business operations. This distinction impacts how depreciation and deductions are applied, offering unique planning opportunities. The short-term rental loophole provides a faster and more accessible way to unlock tax savings, particularly if you're not yet eligible for real estate professional status. Coupled with strategic cost segregation, it's a powerful tool for maximizing cash flow and reducing taxes. Curious about how the short-term rental loophole can work for you? Let's dive into your specific situation and develop a tax strategy that fits your needs.